Welcome to The Debate. Today, we're delving into the vast wisdom literature on personal finance and wealth. And we're tackling a profound contradiction.
Right.
Why is it that the expert advice on building wealth, the advice that centers on ownership and financial independence, why is it so consistently, almost universally ignored by most people?
It is a stunning disconnect. The core principles are often laid out in such explicit, clear terms. The blueprint exists, yet most people choose to remain outside of the structure.
Exactly. So the central question for us today is this. Is achieving financial independence primarily dependent on mastering, let's say, external quantifiable strategies, the systems, the math, the compounding? Or is it fundamentally dependent on mastering internal psychological discipline, the mindset, the sacrifice, the work ethic? Are we talking about optimizing a spreadsheet or mastering the self?
Well, I maintain that any strategy, no matter how clever or mathematically sound, is rendered useless until the internal house is put in order. The psychological barriers, ego, fear, a profound lack of discipline, those are the initial insurmountable roadblocks. They make the strategy, frankly, irrelevant.
I see why you'd think that, focusing on the human element. But I would argue that success is fundamentally a quantifiable, a mathematical endeavor. It's rooted in the structure of asset acquisition. Behavior is certainly a required input, but the engine of wealth, the mechanism that actually generates that exponential growth, is arithmetic.
Okay, so let's break down that mechanism.
The core mechanism is brutally simple, if a bit uncomfortable for some. Employment, by necessity, pays the worker less than the value they produce.
The margin.
Exactly. That critical economic margin, the difference between your labor value and your salary, always goes to the owner. The strategic goal, therefore, is to shift from trading time for money to building ownership, to generating assets that compound, whether they're shares in high-quality businesses or income-producing real estate.
I agree that ownership is the strategic destination, but the problem is that most people fail at the behavioral departure gate. They know the destination, but their internal compass is just completely broken.
Well, the evidence for strategy is right there in the mathematics of compounding. We know the period of accumulating the first, say, $100,000 is the hardest part. It requires aggressive saving, disciplined investing. But once that initial escape velocity is reached, the capital itself begins to do the heavy lifting. If you're saving $500 a month and earning, let's say, 8% returns, the moment your portfolio hits about $75,000, the interest generated in that month starts to exceed your own contribution. At that point, existing capital generates more than your labor contribution. The formula is clear. Spend less than you make, increase your earning power, and invest the difference in appreciating assets. That structure is strategic, not just behavioral.
That's a compelling argument for the power of arithmetic, but have you truly considered why people can't sustain that clear formula? Quantifiable strategies fail because most people are trapped by the sheer predictability of human psychology. Specifically, that insidious force of lifestyle inflation. Every raise, every bonus simply results in a slightly nicer car, or a bigger house, or more expensive restaurant habits. Expenses rise almost predictably to absorb every single increase in income. They remain financially fragile, just, at a higher income bracket.
So you see the primary struggle as internal dependency then, resulting from a lack of self-awareness rather than external economic constraints?
Absolutely. The problem isn't the job. The problem is dependency, and that stems directly from a lack of self-management. The path to independence requires rigorous internal work. You have to avoid self-pity, which the material rightly describes as perhaps the most destructive emotion. You have to combat ego, the belief that you already know everything important, and you have to fundamentally adjust your attitude towards money. See it as a powerful, neutral tool for freedom, not some, dirty or inherently evil necessity. Success before any investment decision is even made is built on foundational behavioral qualities like unwavering persistence and just absolute reliability.
Okay. So if we accept that both arithmetic and attitude are essential, let's tackle the initial barrier. When someone starts out, what prevents them from reaching that initial escape velocity? Is it the mathematical challenge of time and capital, or is it the psychological sacrifice required? I'd maintain that the most significant barrier is the time required for compounding to take effect. The mathematical advantage of starting early is paramount because the clock itself is exponential. Delaying ownership means falling behind exponentially, and that mathematical handicap is why most people just never catch up.
I agree on the power of the clock, but isn't that mathematically advantageous start time only available to those who have already mastered sacrifice? Which comes first? I just don't buy that time is the main enemy. The real barrier is the extreme sacrifice required to fuel that initial compounding, that first $100,000. The material is just replete with anecdotes of successful people who chose to sleep on living room floors or forgo all travel or drive beat-up cars for years, all to aggressively free up every available dollar to buy assets. That early stage is dictated by severe, sometimes agonizing delayed gratification. It requires the internal capacity to look at something you legitimately want, a luxury, a comfort, and just say no. Achieving a psychological state where the act of not wanting it is, in a sense, equivalent to having it. That psychological trade-off has to be mastered before you even start looking at brokerage accounts.
That extreme dedication is certainly the fuel, I agree. But without sufficient mass to light, that discipline only produces minimal returns. If one can only say $300 a month, no matter how dedicated they are to delayed gratification, the yield remains limited. This is why I argue that mastering high-income skills, STEM fields, advanced marketing, complex business operations, is the crucial strategic step. It's not just about saving more. It's about increasing the capital available for investment exponentially. You need a high-octane fuel to make the compounding engine powerful enough to overcome inflation and the sheer cost of living. Skill acquisition is a necessary part of the strategy, not just some bonus.
But mastering high-income skills is delayed gratification, isn't it? It means dedicating years of study, passing up easier paths, and demanding that same relentless persistence we talked about. You are, in essence, arguing that the most effective strategy for capital formation is to first endure a long, grueling, psychological effort to acquire a high-value skill. That sounds like discipline-driving strategy, not the other way around. The strategy is merely the destination, and it's driven by the psychological engine.
I frame it as a strategic input designed to maximize the mathematical outcome. If you are extremely disciplined but earning a low wage, your trajectory is slow. If you acquire a high-value skill, that discipline is suddenly turbocharged. Proving the strategy skill acquisition and maximizing income determines the speed of independence.
We can agree that discipline dictates execution speed. Now, let's shift focus slightly and examine the larger economic context. We operate within a defined financial environment. We have to ask, is the conventional path a systemic trap, or does the capitalist framework provide accessible tools for financial independence?
I see the system as providing extraordinary tools, often masked as complex regulations. But first, I want to hear your argument for why the system is primarily a trap.
Well, I come at it from a sociological perspective. I believe the conventional path, which is largely driven by the prevailing educational and financial structure, is designed to keep people on that working hamster wheel. It aggressively pushes student loan debt onto young adults who can't yet grasp the concept of future capital deployment. They graduate burdened. And the next cultural expectation is the mortgage, a massive 30-year commitment. This process effectively traps individuals in jobs they often dislike, simply to service those two payments. This shared societal delusion prevents the risk-taking and long-term asset building that ownership requires.
I acknowledge the danger of the debt treadmill, but I argue that the system isn't monolithic in its trapping capacity. It also provides incredibly powerful levers that successful owners leverage precisely to escape debt dependency and accelerate wealth. Consider specific tools. The 1031 exchange, for instance, is a profound mechanism. For those unfamiliar, it allows real estate investors to sell an investment property and roll the profits tax-free into a new, larger property. It essentially forces perpetual growth by deferring capital gains tax indefinitely. This demonstrates that the economic structure itself can provide powerful incentives for growth, provided you understand how to use its rules.
That is undeniably a powerful tool,
but it's one that requires the foundational mindset shift we've been talking about. You have to see yourself as an owner, willing to use debt as leverage, rather than as a consumer, using debt to finance instant gratification.
And the ownership path isn't restricted to high net worth individuals. We discussed the FHA loan programs. These are mechanisms that allow buyers to purchase multi-unit properties, say a fourplex, with only 3.5% down. This is the definition of accessibility. It allows people to house hack, living in one unit while the tenants in the other units cover the mortgage payment. The system provides a legal regulated way for a person of modest means to get tenants to build their equity for them. The system is not solely a trap. It is a powerful tool set for those who commit to learning its rules and deploying the necessary discipline.
I concede that the tools exist, and they are powerful. The tension remains, however, between the availability of the tool and the widespread failure to pick it up. The reluctance to engage in that strategic maneuver, the fear of being a landlord, the fear of debt, the fear of complexity, it brings us right back to the psychological inertia that the majority just cannot overcome.
That psychological inertia is what we're fighting. Okay, we've talked about starting, the sacrifice, and the vehicle, the system. Let's pivot to longevity. What is the most essential behavioral quality required not just to get started, but to sustain wealth and relevance for decades? I argue the crucial long-term quality is being a learning machine, a commitment to continuous, incremental learning every single day for 40 years.
Why is that paramount over simply mastering a current skill set?
Because knowledge compounds just as capital compounds. If you learn 1% more about your industry, market dynamics, or investment mechanisms every day, the cumulative advantage over decades is staggering. Furthermore, the rate of change in the modern economy means that skills have a half-life. The people who stop learning the moment they finish formal education are guaranteeing themselves gradual, accelerating irrelevance. Continuous learning prevents obsolescence and is a crucial strategic defense against market shifts. Talent misdirected or stagnated is talent wasted.
That continuous learning is vital for optimization, I agree, but it requires that the foundation beneath it is solid. Before high-level learning, one must master something far more basic and yet surprisingly rare: basic reliability. The ability to simply show up, honor commitments, and produce consistent work. I think back to what is often called the McDonald's lesson, the basic instruction for troubled individuals that focuses solely on being where you are supposed to be, when you are supposed to be there, and doing what you promised. This is the foundational asset. If you are unreliable, no amount of brilliance or specialized talent or compounding knowledge matters, because no one will trust you with real capital, real influence, or complex responsibility. Reliability builds the trust that allows you to be delegated power. That is where most people fail. Constantly. They consistently miss the basic minimum.
I'm not convinced that reliability, which is, the bare minimum for societal function, is the most essential quality for the kind of differentiating success we're discussing. The market pays for specialized knowledge, not just for showing up.
The market pays for specialized knowledge deployed reliably. If a brilliant specialist is erratic, their market value drops precipitously. The quality of persistence, that stubbornness to stay in the chair until the work is done, and reliability ensures that the initial deposits of intellectual capital actually translate into a final product. And this discipline extends further into what I would call social strategy. You must maneuver cleverly to work only for people you admire and respect. Their influence on your judgment, your work ethic, your integrity is nearly inevitable. If you work for someone unethical or mediocre for 20 years, you will become more like them. Protecting your integrity and optimizing your environment is a key, long-term psychological strategy for success that must be maintained.
That choice of environment is certainly high leverage and plays directly into the strategic decision of who you surround yourself with. It's the selection of inputs that maximizes the potential output.
It is the ultimate expression of self-control over one's trajectory.
To synthesize our discussion, I return to my position that achieving independence fundamentally requires embracing the mentality of an owner and recognizing that wealth is a mathematical outcome of compounding assets. The solution lies in structuring your life around capital formation, viewing employment, skill acquisition, and saving as merely means to accelerate the engine of ownership. If you master the systems and commit to the compounding process, growth becomes inevitable, provided you simply don't interrupt the process unnecessarily.
And I maintain that the cleverest strategy is nothing more than interesting theory without the internal fortitude required to execute it, especially through the painful early years. Most people self-sabotage through ego, through fear-driven consumption, and a profound lack of self-awareness, condemning themselves to a cycle of dependence. The hard truth is that success is built on unpopular behavior, aggressive sacrifice, unwavering self-awareness, and unyielding reliability.
Ultimately, both the arithmetic and the attitude must align to attain the ultimate goal of wealth, which is freedom. The freedom to choose what work to pursue and with whom to spend your limited time, rather than being motivated by simple financial necessity.
We can certainly agree on that destination. The discussion, however, must always continue to wrestle with whether the lock is broken by the key of calculation or the hammer of discipline. There is clearly much more to explore in the material regarding the necessary interplay between personal choice and the constraints of the economic environment.